Your portfolio isn't a plan. I know that sounds harsh, but here's what I mean. If you're a high earner, an executive, a business owner, or climbing the ladder, your biggest financial lever isn't picking the right fund. It's making structured decisions about when to realize income, how to defer taxes, where to locate assets, and how to sequence withdrawals. Those choices compound year after year. And the earlier you start making them intentionally, the bigger your tax advantage becomes. I'm going to show you what a real financial plan includes and the 6 phases that turn uncertainty into compounding good decisions. And then I'll show you the difference it makes using a real financial planning software, not just a spreadsheet. Let's go. I'm Dan Pasco, founder of Tailored Wealth. And before I started advising clients, I was an executive. I understand from personal experience the time pressure, the decision fatigue, and the fear of overpaying taxes for decades without realizing it. Today, I'm breaking down the framework that we use with clients to show you what professional financial planning actually looks like. So, what is a real financial plan? Here's my definition. A professional plan is an integrated model across 6 critical phases: cash flow, retirement, risk, expense planning, retirement planning, and legacy. It's not a binder that sits on a shelf. It's not a spreadsheet with formulas that break when life changes. And it's not a retirement number that someone pulled out of thin air. A real plan is a living model that runs scenarios, evaluates trade offs, and adapts as your life evolves. It answers questions like, can I buy the lake house and still afford to retire at age 55? Or, if I take this new job with a $200,000 signing bonus, how should I structure it to account for taxes? Or, what's the optimal way to withdraw money in retirement so I'm not overpaying the IRS? Those aren't guesses, they're modeled decisions. And that's what we're walking through today. I'll give you the non-negotiables in each phase, the key decisions, and the visuals that you should see when working with a professional. Let's start with phase 1, cash flow management. The goal is to align your income, spending, and savings to fund your priorities with intention. Key decisions: what's your savings rate target? Do you have 6 to 12 months of expenses in an emergency fund? How much of your spending is fixed versus variable? Should you pay down debt aggressively or invest the difference? Those aren't philosophical questions, they're design choices. Now, here's what you should see. In a professional software like Right Capital, you'll see a cash flow dashboard that maps your savings goals and shows whether you're on track. Automate your savings first. Pay yourself before anything else, and set a quarterly check-in to true up your targets. Pro level tip: most people save backwards. They spend first and save what's left. Flip that script. Automate your savings and then live on what remains. It's the single biggest behavior shift that compounds over time. Phase 2 is retirement planning. And the goal is to make work optional on your terms and define when and how much you need. Key decisions: what's your retirement age? Or better yet, when do you want to be work optional? What's a safe spending band in retirement? When should you start Social Security? If you have company stock or a pension, how does that integrate into your plan? That's where the probability of success dashboard comes in. It's a Monte Carlo simulation that runs thousands of market scenarios and gives you a confidence percentage that your plan will actually work. You should see a slider where you can adjust your retirement age and watch your probability change in real time. Example: change your retirement age from 60 to 62 and watch your plan confidence go from 78% to 91%. That's not guessing, it's modeling. Pro level tip: don't lock yourself into a single percentage withdrawal like the 4% rule forever. Use what I call guardrails, floors and ceilings, to adjust upwards when markets are up and pull back slightly when markets are down. That flexibility not only protects your plan, but allows you to live better. Phase 3 is risk management, and the goal is to keep bad outcomes from derailing your plan. Key decisions: what's the right coverage threshold for life insurance, disability, and umbrella liability? And should you self-insure or transfer the risk? And do you have concentration risk, like too much wealth tied up in one company stock. You should see an insurance needs summary and a balance sheet view that shows your assets, liabilities, and coverage gaps. Pro level tip: tie your coverage to income replacement math and asset protection, not some insurance salesperson's quota. If you're financially independent, you might not need the life insurance at all. If you're still building wealth and supporting a family, it's a non negotiable. Context matters here. Phase 4 is expense planning. And the goal is to model irregular and high impact costs so they don't blindside you. Key decisions: when are you funding college and how much? Are you buying a second home, doing a renovation, or planning a sabbatical? Do you anticipate caregiving costs for aging parents? You should see a goal timeline that stacks your funding needs with your available resources over time. Example: if you want to buy a lake house in 3 years and send your first kid to college in 6, the plan shows you whether you can do both or if one needs to shift. Pro tip: stress test 2 big lifestyle choices at the same time to see how they interact. That's where real planning value shows up, because you can see the ripple effects before you commit. Phase 5 is tax planning, and it's the center of gravity for any high earners. The goal is to reduce your lifetime tax drag, not just this year's bill. Taxes are your largest controllable bill, and most people overpay for decades because they don't make structured decisions. Key decisions: how do you time income realization, bonuses, equity vests, capital gains? Should you bunch deductions in high income years? Should you run Roth conversions in early retirement when your income drops? What's your income sequencing in retirement? Taxable first, tax deferred next, tax free last? How do you locate assets for tax efficiency? High growth in Roth, income heavy in pre tax, liquid and taxable? When should you start charitable strategies like donor advised funds or qualified charitable distributions? You should be able to compare the cumulative taxes paid under your current plan versus a proposed plan, as well as after tax income projections year by year, and a clear view of how much you'll save over your lifetime, not just this year. Let's say you retire early at age 55 with a few years of low income before Social Security kicks in. That's the golden window to do Roth conversions, which is shifting assets from pre-tax IRAs and 401ks into Roths while you're in a lower tax bracket. The plan models that and shows you the lifetime tax savings. Maybe it's 150K, maybe it's 300K or more, depending on your situation. But you never know without running the scenario. Think about tax diversification as an explicit design goal. You want to balance across taxable, tax deferred, and tax free so you have the flexibility to pull from the most efficient source in any given year. And that flexibility is worth real money. Phase 6 is legacy planning, and the goal is to transfer wealth with purpose and minimal friction and tax waste. Key decisions: do you have a will and trust basics in place? Are your beneficiaries coordinated across all accounts? How are your assets titled? Individually, joint, or in a trust? Do you have a lifetime gifting strategy? What's your charitable intent? You should see an estate flow summary and a beneficiary map, even if it's a simple schematic. Legacy isn't just about documents, it's about values and control. Do you want your wealth to impact your kids, your community, your causes? Design for that, not just tax efficiency. Now let's talk about tools. Excel and online calculators can't do what I just described. They can't run multivariable, tax-aware, dynamic scenarios. They can't keep pace with life changes, and they can't model the effects of different decisions. That's why we use licensed planning software like Right Capital, because it models scenarios and updates continuously. Here's what the process looks like. You spend about 30 minutes filling out a planning profile: income, assets, expenses, liabilities, goals. Then we build the model, run scenarios, and show you the what ifs. What if you retire 2 years earlier? What if you do Roth conversions? What if you buy the second home? You see the impact immediately. And that's the value of using a professional planning software operated by someone who knows how to use it. Let me show you 2 quick examples, All the numbers are illustrative for education. Case one is dual income executives. High W 2 incomes, big annual bonuses, but no coordinated tax plan and ad hoc charitable giving. Their plan strategies include deduction bunching and a donor advised fund in large bonus years. Backdoor Roth contributions and asset location shift, moving high growth assets to Roth and high income assets to pre tax. A modeled early retirement Roth conversion window and withdrawal sequencing throughout retirement. The result? The probability of success improved from the mid 70s to high 80s. Lifetime taxes dropped by high six figures, and after tax income smoothed across retirement with no huge tax spikes. Case number two is a business owner approaching work optional. She owns an S Corp with lumpy income, no spending guardrails, and no clear plan on when she can step back. Her plan strategies include a calibrated S Corp salary for optimal tax treatment, a designed 401k with cash balance for accelerated savings, Roth conversions during lower income years, and set spending guardrails based on safe withdrawal analysis. The result? A more predictable net worth trajectory, lower cumulative taxes, and a clear answer on a safe spending band so she has confidence on when she can downshift. In both cases, the plan wasn't just a document, it was a decision engine that compounded good choices over time. And one more thing, a plan isn't just one and done. Life changes, new job, new baby, tax law shifts, market changes. That's why we operate on a quarterly strategy rhythm. We update the model, evaluate key decisions, and change the plan as needed. It's not about perfection. It's about staying current and making informed decisions as life unfolds. And that's how you keep the compounding advantage working for you. All right, let's bring this home. A real financial plan integrates 6 phases: cash flow, retirement, risk, expenses, taxes, legacy. It's not a spreadsheet, it's a living model that compounds good decisions. And the earlier you start, the bigger the advantage. For high earners, that 30 minutes you invest in building the planning profile pays you back for decades in after tax dollars. Now, here's what I want you to do next. I just showed you what goes into a plan, the framework. Now go watch my video on life-driven investing. It shows you how to take the financial plan and turn it into a custom portfolio, mapping your investments for the next 1, 5, and 10 years of your life so your money is there for you when you need it. And that's where the plan becomes real. The link is in the description below and available at yourtailoredwealth.com. And if this was helpful, like and subscribe. I'm putting out content like this every week for high earners that want clarity, confidence, and control over their wealth. I'm Dan Pascone with Tailored Wealth. Thanks for watching, and I'll see you in the next video.